Close your eyes for a second and imagine it's 2036. You're 10 years older. You've worked every year between now and then. You've earned money, spent money, and made 1,000 small financial decisions that felt completely normal at the time. But something is wrong. The retirement account you were going to start funding seriously next year, you never quite got around to it. The credit card balance you were going to pay off when things settled down, it grew instead. The house you planned to buy once the timing was right, the timing never felt right, and now the math is significantly worse. The raise you got 3 years ago, you can't tell where it went because your lifestyle expanded to absorb every dollar of it before you had a chance to think. You're not broke, you're not in crisis, but you're also not where you thought you'd be. And the worst part is that you can trace it back. The decisions that created this outcome weren't dramatic. They weren't reckless. They were ordinary. They were the kind of decisions millions of people make every single day while telling themselves they'll course correct later. Later has a way of becoming now without warning. Here's what makes financial regret different from other kinds of regret. It compounds. A bad relationship decision costs you time and emotional energy. A bad financial decision costs you money and then costs you more money on top of that every year for as long as the decision goes uncorrected. The gap between where you are and where you could have been widens automatically. You don't have to do anything to make it worse. Inaction does that job on its own. This video covers 8 financial decisions that look completely reasonable right now, but produce outcomes most people aren't prepared to face in 10 years. Some of them will feel uncomfortably familiar. Some might feel like things you've already decided to deal with eventually. The math in this video exists to show you what eventually actually costs. The next 10 years are going to pass regardless. The only question is what you'll have built by the time they do. Decision 1. Treating your emergency fund as optional. Right now, not having a fully funded emergency fund feels manageable. You've gotten this far without one. Things have been mostly fine. If something came up, you'd figure it out. A credit card, a family loan, some version of improvisation that has worked before. This logic holds up perfectly until the moment it doesn't. According to Bankrate's 2025 Emergency Savings Report, 57% of Americans could not cover a $1,000 emergency expense from savings. Not $10,000, not $5,000, $1,000. More than half the country is one minor car repair, one unexpected medical bill, or one appliance failure away from going into debt. Here is what that looks like in practice over 10 years. An emergency hits, let's say $3,000, which is a modest number for anything involving a car, a medical situation, or a home repair. No emergency fund means that $3,000 goes on a credit card at 24% APR, which is close to the current national average. Minimum payments get made, life continues. The balance doesn't disappear, though. With minimum payments on a $3,000 balance at 24% interest, full payoff takes approximately 14 years and costs $4,200 in interest alone. That single $3,000 emergency costs $7,200 total because no emergency fund existed. Multiply that by 2 or 3 emergencies over a decade, which is a conservative estimate for most households, and the absence of an emergency fund costs $15,000 to $20,000 in interest payments that a 3 to 6 month savings cushion would have made completely unnecessary. The reason people don't build emergency funds is not usually income. It is priority. An emergency fund does nothing visible. It sits in an account generating modest interest and looking inert. There is no immediate reward for building it, no dopamine hit, no status signal. It is pure financial defense with no offensive excitement. So it keeps getting deprioritized in favor of things that feel more immediate. The alternative is straightforward. A high-yield savings account currently paying 4 to 5% annually on a $10,000 emergency fund generates $400 to $500 per year in interest, while simultaneously eliminating the need to ever finance an emergency. The fund pays you to have it and saves you thousands when you need it. 10 years from now, the person who built the emergency fund has a financial cushion that absorbed every unexpected expense without debt. The person who kept treating it as optional has a credit card history dotted with emergency charges and a net worth measurably lower than it should be. The emergency is not optional, only the fund is. Decision 2. Staying in a job you've outgrown because it feels safe. This decision rarely feels like a financial decision. It feels like a lifestyle decision, a comfort decision, a decision about risk tolerance and personality. But the financial consequences of staying too long in a role that has stopped growing you are among the most expensive on this entire list. Here is the math that most people have never run. The average annual salary increase for employees who stay at the same company is 3 to 4%, according to data from the Bureau of Labor Statistics. The average salary increase for employees who change jobs is 10 to 20%, according to research from the Pew Research Center. That gap, sustained over a career, produces dramatically different financial outcomes. Start with a $60,000 salary. Employee A stays put, receives 3% annual raises. After 10 years, they earn approximately $80,600. Employee B switches jobs strategically every 3 to 4 years, capturing 15% increases each time. After 10 years, they earn approximately $121,000. The income gap between these two people after 1 decade is over $40,000 per year. Over the full 10-year period, the cumulative earnings difference exceeds $200,000. That $200,000 gap didn't come from employee B working harder or being dramatically more talented. It came from being willing to have uncomfortable conversations, update a resume, and sit in job interviews. The financial return on that discomfort is extraordinary. The reason people stay is real. Change is genuinely uncomfortable. A known environment, even a limiting one, feels safer than an unknown one. There are relationships, routines, and institutional knowledge that have value. The inertia of staying is powerful and not entirely irrational. But the cost of that inertia is not neutral. Every year spent in a role paying below market rate is a year of lost compounding. Not just the income difference, but the retirement contributions that would have been made on the higher income, the investments that would have been funded, the financial margin that would have been created. The person who stays comfortable in a role they've outgrown will look back in 10 years and be able to calculate almost exactly what that comfort cost. It will be a large number. The discomfort of switching jobs, in retrospect, will look like the best financial decision they could have made. Decision 3. Carrying credit card debt as a permanent fixture. For a significant portion of Americans, credit card debt has stopped feeling like an emergency. It has become part of the financial landscape, a balance that moves up and down but never quite reaches zero, a monthly payment that gets made without much thought about the underlying total. This normalization is one of the most expensive things that can happen to a person's finances. The average credit card interest rate reached 24.37% in early 2025, according to the Federal Reserve. The average American household carrying a balance owes approximately $6,380 in credit card debt, according to Experian's 2024 State of Credit Report. At 24% APR on $6,380, that household pays approximately $1,531 annually in interest charges, just to maintain the balance at its current level without reducing it at all. Over 10 years, that same $6,380 balance costs $15,310 in interest if only minimum payments are made. The original debt nearly triples in total cost. The $6,380 purchase, or more accurately, the accumulation of small purchases that built the balance, ends up costing over $21,000. But the hidden cost is larger than even that number suggests. That $1,531 in annual interest payments is money that cannot be invested. At 8% annual returns over 10 years, $1,531 invested annually becomes approximately $23,000. So the true cost of carrying that credit card balance is not just the $15,310 in interest paid, it is the $15,310 in interest paid plus the $23,000 in investment growth that never happened. The total opportunity cost of normalized credit card debt approaches $38,000 over a decade for a balance that feels routine and manageable right now. The reason people carry balances is not usually ignorance. Most people understand abstractly that credit card interest is expensive. The problem is that the cost is invisible in any given month. The minimum payment gets processed, life continues, the balance doesn't scream, it just quietly extracts wealth in amounts small enough to avoid triggering alarm, while large enough to cause serious long-term damage. The decision to aggressively eliminate credit card debt before investing anything else is one of the highest guaranteed returns available in personal finance. Paying off a 24% interest debt is equivalent to earning a 24% return on that money. No investment reliably matches that. Debt elimination is the investment. 10 years from now, the person who treated credit card debt as permanent will have paid tens of thousands of dollars in interest for the privilege of carrying a balance they could have eliminated. The person who attacked it aggressively will have redirected that same money into assets that grew. Decision 4. Not negotiating ever. This decision is almost entirely invisible because it leaves no trace. The money that was never earned, the bill that was never reduced, the contract that was never pushed back on, these don't show up anywhere. There is no record of what was left on the table. That invisibility is precisely why most people never address it. Research from Carnegie Mellon University found that failing to negotiate a starting salary costs the average worker $500,000 over the course of a career. Not because they never received raises, but because every raise, every bonus, and every future salary negotiation is calculated as a percentage of the base. A higher starting point compounds upward just as powerfully as money in an investment account. The negotiation gap extends well beyond salary. Car purchases. The average person accepts the first offer at a dealership. Research from Consumer Reports found that most car buyers leave $1,000 to $3,000 on the table by not negotiating effectively, not understanding dealer incentives, and not timing purchases strategically. Medical bills. A 2023 report from the Kaiser Family Foundation found that 67% of Americans who attempted to negotiate a medical bill received a reduction. The average reduction was 35%. Most people never attempt it because they assume the bill is fixed. Insurance premiums. Calling your insurance provider annually and asking for a better rate or indicating you're considering switching produces a discount for a significant portion of policyholders. The average household that does this saves $200 to $400 annually across auto and home insurance. Rent. In markets where vacancy rates are above 5%, landlords regularly negotiate lease terms, especially for reliable long-term tenants. The average successful rent negotiation saves $50 to $2,400 monthly, $600 to $2,400 annually on one of the largest household expenses. Add these categories together over 10 years, and the person who never negotiates anything has left $50,000 to $150,000 on the table compared to the person who negotiates consistently. Not through aggression or conflict, through the simple habit of asking. The reason most people don't negotiate is discomfort, the fear of rejection, the feeling that asking is somehow rude or presumptuous, the assumption that prices are fixed when they almost never are. That discomfort is the most expensive feeling in personal finance. It costs more per year than most people realize, and it compounds silently over decades into a number that would genuinely shock most people if they calculated it. Decision 5. Lifestyle creep on every income increase. Every time income goes up, spending goes up to match it. The raise gets absorbed. The bonus disappears. The new salary feels exactly as tight as the old one within 6 months, because every dollar of additional income found a new destination before it could be directed somewhere intentional. This is lifestyle creep, and it is the primary reason high earners end up just as financially stressed as lower earners. Goldman Sachs research found that 41% of Americans earning between $300,000 and $500,000 annually report living paycheck to paycheck. 40% of those earning over $500,000 report the same. These are not people with income problems, they are people with lifestyle expansion problems. Every income increase was immediately consumed by a corresponding expense increase, leaving zero additional margin regardless of how much more they earned. The math of lifestyle creep is brutal when you examine it across a decade. Someone earning $65,000 receives a raise to $75,000. The $10,000 increase represents approximately $7,500 in additional take-home pay after taxes. If that $7,500 is invested annually at 8% returns, over 10 years it becomes approximately $116,000. If, instead, it gets absorbed into lifestyle, a nicer apartment, a newer car, more frequent dining out, it produces zero financial return. The person earns $10,000 more per year for a decade and has nothing additional to show for it at the end. The pattern repeats with every subsequent raise. Each one gets absorbed, each one produces nothing permanent. 10 years of income growth with proportional lifestyle expansion, the person has a higher standard of living and an almost identical financial position to where they started. The antidote is the income delay rule. When income increases, maintain the previous lifestyle for a minimum of 12 months. Direct the entire income difference to debt elimination, emergency funds, and investments. Allow lifestyle improvements only after financial goals are funded. The lifestyle still improves, it just improves on a lag that creates compounding wealth in the gap. This is uncomfortable in a social context. Friends upgrade when they earn more. Colleagues drive nicer cars after promotions. The cultural expectation is that visible lifestyle should reflect current income. Resisting that expectation requires a clarity about long-term goals that most people don't develop until they're watching their retirement savings fall short at 55. 10 years of capturing income increases instead of spending them is the difference between financial options and financial obligation. It is one of the most powerful levers available, and one of the most consistently ignored. Decision 6. Avoiding the stock market because it feels risky. A significant portion of Americans are sitting on cash savings that are losing purchasing power every year because investing feels more dangerous than not investing. The stock market goes down sometimes. Headlines about crashes and corrections are frightening. The money in a savings account feels safe in a way that money in an index fund does not. This feeling is mathematically backward. According to Gallup's 2024 Economy and Personal Finance Survey, 37% of Americans own no stock market investments whatsoever. No 401k beyond the minimum to capture any employer match. No IRA. No brokerage account. Nothing. For many of these people, the decision is framed as caution. In practice, it is one of the most expensive financial decisions a person can make. Here is what avoiding the market actually costs over 10 years. $500 invested monthly in a low-cost S&P 500 index fund at the historical average of approximately 10% annually becomes $102,000 after 10 years. The total amount contributed is $60,000. The market growth added $42,000 on top. That $42,000 is money created from nothing except time and the decision to participate. $500 kept in a high-yield savings account at 4.5%, which is a favorable rate by historical standards, becomes $75,000 after 10 years. The difference between investing and saving is $27,000 over 1 decade on $500 monthly contributions. The gap widens dramatically over longer timeframes. Over 30 years, the same $500 monthly in the market becomes approximately $1.13 million. In the savings account, it becomes $390,000. The cost of avoiding the market across a working career is not a modest difference. It is the difference between financial independence and financial dependence. The risk framing that keeps people out of the market is also factually incorrect for long-term investors. The S&P 500 has never produced a negative return over any 20-year period in its history. Corrections happen, crashes happen. For the long-term investor who continues contributing through downturns, those crashes are not losses. They are discounts on future growth. The person who avoids the market for 10 years because it feels risky will look back and see exactly what that caution cost in dollar terms. It will be a very large number that no amount of careful savings account management could have produced. Decision 7. Having no plan for your income. Most people experience their income as a flow rather than a tool. Money comes in, obligations get paid, whatever remains gets spent on a combination of intentional and unintentional purchases, and the cycle repeats. There's no architecture to how the money moves. There is no predetermined destination for each dollar before it arrives. This is not budgeting as a moral failing. It is the natural default state of human financial behavior. Without a deliberate system, money follows the path of least resistance, which is always toward immediate consumption rather than future accumulation. Research from the National Endowment for Financial Education found that people with written financial plans accumulate significantly more wealth than those without them, controlling for income. The planning itself changes behavior. When money has a predetermined destination, it arrives there. When it doesn't, it disappears into the ambient spending that fills whatever space is available. The cost of having no plan compounds across 10 years in a specific way. Someone earning $70,000 annually with no financial plan saves on average 3.6% of income, according to the Bureau of Economic Analysis 2024 Personal Savings Rate data. That's $2,520 per year, or $25,202 over a decade. Someone on the same income with a deliberate plan that directs 15% to savings and investments saves $10,500 per year, $105,000 over the same decade. The income is identical. The outcome is $79,800 apart after 10 years, driven entirely by whether the money had a destination before it arrived. A financial plan does not need to be complicated. The most effective personal finance systems are remarkably simple. Automatic transfers on payday that move predetermined amounts to retirement accounts, emergency funds, and investment accounts before the money ever reaches checking. A rough monthly spending target for discretionary categories. A quarterly check-in to assess whether the numbers are on track. The barrier is not complexity. The barrier is the same one that keeps people from exercising or eating better. Starting feels harder than not starting, and the cost of not starting is not immediately visible. The cost becomes visible 10 years later when the math reveals exactly how much the absence of a plan actually cost. Decision 8. Deprioritizing retirement contributions in your 30s. This is the decision with the largest financial consequence on this entire list, and it is the one most commonly rationalized as reasonable. There are always things competing with retirement contributions: student loans, a house down payment, kids, a car, the present cost of living. Retirement feels distant, abstract, and less urgent than every tangible financial pressure visible right now. Catching up later feels not just possible, but likely. The plan is always to contribute more once the immediate pressures ease. The immediate pressures rarely ease. They change form, and compound interest does not wait. Here is the math that changes how people think about this decision. Someone who contributes $500 monthly to a retirement account starting at age 30 and stops completely at age 40, making zero additional contributions for the next 25 years, will have approximately $598,000 at age 65, assuming 8% annual growth. Total amount contributed, $60,000 over 10 years. Someone who waits until age 40 to start and contributes $500 monthly every single month until age 65, 25 years of consistent contributions, will have approximately $473,000 at age 65. Total amount contributed, $150,000 over 25 years. The person who contributed for only 10 years in their 30s and stopped made more money at retirement than the person who contributed for 25 years starting at 40. They contributed $90,000 less and ended up $125,000 ahead. That is the power of compounding in the early years, and it is why deprioritizing retirement contributions in your 30s is so devastatingly expensive. Every year of delay between now and starting or maximizing retirement contributions costs more than the previous year of delay. The math accelerates against you. A 35-year-old who starts contributing $500 monthly will accumulate approximately $745,000 by 65. A 40-year-old starting the same contribution accumulates $473,000. The 5-year delay cost $272,000 for the exact same monthly contribution over the remaining working years. The employer match compounds this further. According to Vanguard's 2024 How America Saves report, 79% of employers offer a 401k match. The average is 4.5% of salary. An employee earning $65,000, whose employer matches 4.5%, is leaving $2,925 in free annual compensation on the table by not contributing enough to capture the full match. Over 10 years, that uncaptured match plus its investment growth represents approximately $46,000 in free money that was available and declined. The rationalization that makes this decision feel acceptable is the belief that catching up later is realistic. The math shows it is not. Not because catching up is impossible, but because catching up requires dramatically larger contributions to produce the same outcome that earlier, smaller contributions would have generated automatically. You cannot buy back time in a compound interest environment. The years in your 30s are the most valuable investment years of your financial life, and they are available exactly once. These 8 decisions share a common structure. None of them feel catastrophic in the moment. Each one has a completely reasonable justification available. The emergency fund can wait until cash flow improves. The job is fine for now. The credit card balance will get paid eventually. Negotiating feels awkward. The lifestyle upgrade was earned. Investing seems risky right now. The budget can happen later. Retirement contributions will increase next year. Every single one of those sentences is a sentence produced by millions of people every single day. And every single one of them is a sentence that produces a specific financial outcome 10 years later that the person saying it has not fully calculated. The decisions on this list are not rare mistakes. They are the financial default settings of modern American life. The average person makes most of them simultaneously, and the costs stack on top of each other in ways that are genuinely difficult to recover from once a decade has passed. Run the numbers for your own situation, not abstractly, specifically. What does your credit card balance cost you in interest annually? What would that money become if it were invested instead? What is the difference between your current salary and your market rate, and what does that gap cost over 10 years? When did you last negotiate a bill, an insurance rate, a medical charge, or a contract? What happens to every raise you receive, and where does it go within 6 months? These are not rhetorical questions. They have specific dollar answers. And the people who have calculated those answers are the ones who found them uncomfortable enough to change something. 10 years from now exists whether you prepare for it or not. The only variable is what you'll have built by the time it arrives. The decisions are being made right now. Some of them are being made by default, which is itself a decision. The question is whether you're making them consciously or just letting them happen while you focus on everything else. Your future financial situation is being written today. The only question worth asking is whether you're the one holding the pen.